partner of Intrepid Capital Management, which is a Jacksonville-based money management firm. And if you've been around the series for a couple of years, Eric Cinnamon, who's an equity manager with the same firm, came through. I don't know, last year, 2 years ago.
Yeah, it was last year.
Last year. Right, so we have Intrepid back-to-back. Mark will be talking about the junk bond market. You know, as I put this speaker series presentation together, the roster of people, I try to cover a lot of different areas, and as many as I can. And that's one area I've always wanted to have a junk bond manager, but I didn't really know any, and I certainly didn't know any around here until, by a set of coincidences, I ran into Mark. So Mark is, again, the founding partner of Intrepid Capital Management. These are, this year, our only non-gator. He's a graduate of the University of Georgia, which is just a little bit better school than the University of Florida. We all aspire to go there later on in life. But anyway, Mark, thank you for taking time out today.
Thank you. I don't know if you all hear me on this?
It's working. No, they don't.
I'm sorry?
They don't hear you. It's for recording purposes.
Oh, it's recording. Okay. Can y'all hear me okay?
Yeah.
I'm glad to see there's only one tie here. I didn't want to wear one. I'm not going to wear this coat either. Happy Friday to everybody. Thank you, Dr. Brown, for having me. You know, speaking to the University of Georgia, University of Florida issue, I'm really more of an agnostic as far as football goes. I happen to have gone to school at Bowles in Jacksonville, where I was a co-captain of my high school football team. I like to say I was small but slow. And one of my classmates was actually a very, at the time, famous Gator, a guy named Bobby Raymond, who ended up, I think, leading the SEC in scoring in the mid-'80s as a field goal kicker. But I'm glad to be here, and if my kids chose to go to the University of Florida, I would wholly endorse it. I think y'all have got a great opportunity here, and I think, like the University of Georgia, a big school like Florida, you're only going to get what you take out of it. So I'm glad to be here, and hopefully you'll ask a lot of intriguing questions that I can answer. With that, I'm going to proceed. Which way do I point this thing? Right there. Anywhere.
Theory, yeah.
Just want to give you all a little background on me. Again, I went to Bowles, which you may be familiar with, prep school. As I've shown in very small font, I went to the University of Georgia, which I do have a little surprise for you later in the presentation. Like I was talking to Dr. Brown just a minute ago, I think that you know, a lot of what I've learned was really in kind of the school of hard knocks. And really on the job. I think one of the advantages I might have to a highly technical person is, at least from my perspective, being a Bachelor of Arts in economics and really a liberal arts major, I don't have the real definitive view of how things should be. And that's one thing I would caution all of you not to do, because I've had work for me gentlemen that were CPAs, at the same time I graduated from Carolina Business School, CFAs, and as I describe it, I think as you come out of the birth canal, if you let it, that academic process may narrow your view, and I would hate to see that for all of you. There's a lot of opportunity, and you know, try to use that rigorous background that Dr. Brown and others are imparting, but try to keep an open mind as to what's possible, and that's really the way I look at it. I thoroughly enjoy being in the financial markets. As I said to the young fellows I had lunch with, to me it's like trying to figure out a woman. You know, I've been married 17 years and I still haven't figured it out yet. Not to disparage the ladies in the crowd. I started out of school at E.F. Hutton, which it was made famous by when E.F. Hutton speaks, everybody listens. Whether you realize it or not, some of you are probably too young to remember, E.F. Hutton actually failed after the market crash in 1987. The parts were picked up by Shearson Lehman, and then it went through a series of mergers and eventually became Smith Barney. During that time, we had some attractive customers, including one that's just to the south here, Shands Hospital. We were a consultant in the late 80s to a gentleman named Wayne Tharp, who may still be there, who was the CFO, both for the pension fund for the hospital as well as the bond reserves they had from municipal underwritings. In addition to that, we did some work for a Clay Electric Co-op, which is not too far from here in Keystone Heights, the city of Brunswick, Georgia, and then the Haskell Company, which is a large construction firm in Jacksonville.
Pension plans.
Yeah, all qualified, all of them driven by trustees. But what I took from that experience, and this is what you might think about as you're entering the workforce, and again, Dr. Brown kind of brought this to light. I think that you may have an idea where you'd like to end up after school, but there may be a circuitous route that takes you there. My circuitous route was, in essence, a broker at E.F. Hutton as a 22-year-old. And keep in mind, prior to starting there, my longest conversation was, hey, you want to meet me at the corner for a beer? I was introduced to a stack of, I think, D&B cards and handed a desk and a telephone and wished good luck. I found that over time, my natural audience was with CFOs and financial officers and CEOs. Coincidentally, I married a woman who's a CPA, so I had some understanding of how they think. But what I learned in placing money for a variety of these firms, I kind of learned the good, the bad, and the ugly of the money management industry. Every morning I could come in and turn on, I think at the time was a Bunker Ramo, I think it's owned by ADP, a screen and see what a currency manager was doing in Boulder, Colorado, or a small cap growth manager was doing in San Francisco, or a junk bond manager was doing in Atlanta. And so I tried over the course of that decade kind of to integrate the best of practices from observation, really. So even if you don't get the offer you're looking for coming out of school, you may find that something gets your foot in the door that may get you where you want to be 5 or 10 years hence. Again, we started Intrepid Capital a little over 11 years ago in January of '95. One of the principles that I founded it on was price is not indicative of value. When I looked across the platform of what were considered at that time world-class money management firms, I think that a lot of them, for lack of better terms to me, were really index huggers, as I've heard an Australian refer to it. They were so geared toward their benchmark that, I hate to say it, but I've got a fairly bright 12-year-old daughter who could probably go to my Bloomberg machine, pull up the Russell 2000, figure out what the ticker symbol is, multiply it by the percentage, and put it in your portfolio. I didn't see how that was a long-term prospect for running a business. So I wanted to go to where two things I thought would happen. One, where we could protect our margins and earn a reasonable fee in a business that in that decade has become more and more commoditized. And number two, go to where I felt like the markets were less efficient. I don't think, frankly, that the analysts that work at Intrepid Capital, which, by the way, to give the plug again for the University of Florida, of the 15 employees I have, 5 of them are UF grads. So I'm actually a big supporter of the school in an indirect sort of way. But I felt like that we could add value in less efficient parts of both the stock and the bond markets. Again, in the late 90s, a lot of what you saw was a trend toward indexation in the equity market, and as rates had dropped starting in '82, it's like why leave the investment grade credits for anything better? I like to say it's where no one looks. Again, up until several years ago, most people were in the NASDAQ top 5 or 10, way up in the S&P and the capital structure, in the rankings. Junk bonds have always elicited kind of a cold chill on trustees or the retail buyer. I really think of kind of what I do is I'm a repo man. Again, just to define the market for you, and I know y'all probably know this, market cap, small cap is market cap times shares outstanding, less than 2 billion, and an S&P rating of less than BBB minus. Part of my frustration in the fixed income was that in placing money, whether it was for Shands Hospital when they had $20 million, they were trying to arbitrage against their financing cost. A lot of managers that we'd raise money for, as soon as it would land at the respective account, would promptly ladder a 2, 3, and 4 year treasury. About a day later, I'd call them up and say, well, you know, can't we do something to add value? And I'd usually hear some mumbo jumbo about, well, liquidity, da-da-da-da-da, can't do it, doesn't fit. And so kind of from that point, I thought, you know, if I ever start my own firm, I'm going to try to figure out how to actually add value to 40%, in a lot of cases, of people's portfolio. I think Intrepid Capital is different. It's a point of differentiation, but it's also problematic from a marketing standpoint. And if any of you are marketing gurus, I'd love to hear your opinions after class. I think the conundrum, if you will, is that our focus has been an absolute return. By that I mean I think our customers are better off with more money at the end of this year and subsequent to the next versus a relative performance. I've got it on here. I've called it consultant's folly, and I talked a little bit about this at lunch today. To me, the consultant's folly is for me to make a call on the Florida Foundation or to maybe even be managing money there and to go in to report to them and say, in, let's see, 2002, say, you know, I'm really pleased to report that we have outperformed the S&P 500. And that's the good news. The bad news was the S&P that year was off 22%, and we only lost 20% of your capital. Somehow that's never been able to roll off my tongue. So our focus is a lot different than that, but the conundrum comes in that most of the placement for money management services are driven by a consultant that wants to fit you in a nice, tight little box with cash constraints, sector restraints. As I describe it, they tie you up like Harry Houdini and then ask you why you can't swim a year or two later.
Since we've got kind of a smaller, more sophisticated audience here, let's just talk about that a little bit. I mean, you know, the point is that everybody knows this, right, is that they're going to have a big fund, you're going to have a lot of money, and the thesis, the consultant's thesis, and correct me if I'm wrong, is sort of, people are specialists, and so they're going to add value. Mortgages are going to add value here, they're going to add value there. But that, and what we all know, and everybody knows, that the real money to be made is whether or not you're in the right market, stocks or bonds, right? I mean, that's where, the best mortgage manager in the world can't add enough value knowing, right, relative to having 10% more money in stock in a good year than in bonds. I mean, that's just clear. So it's incumbent on the consultants to really time the market and to make these big picture calls. But you know, there's so many money managers I think that have a very good sense about whether junk bonds are intrinsically rich or cheap, or whether equities are intrinsically rich or cheap, and that process gets short-circuited.
Well, I think you've got to realize that the consultant is emotionally hardwired just like everyone else. So, from my perspective, the consultant is the trustees have just abdicated for a fancy case of CYA to the consultant. They've abdicated the job of selection. But my view, having managed money for customers of ours who use a consultant, the consultant hasn't had any value. He's reported, and he's getting some transactional activity through his brokerage desk, or he's getting a hard dollar fee, but he really hasn't added any value to their circumstance in a lot of cases. But you've got a lot of, it's almost inverse to me, the amount of money to, on some ways, the level of sophistication. If somebody has, they're only holding, they have $100,000 in life, they're very focused on how that money does, but you give a board of trustees $100 million to watch over, and they do something besides worry about that $100 million, they'll abdicate it to a consultant, and a lot of times not do as well as an individual might.
Are your clients primarily trusts or pension plans, or do you have individual?
Some of both, actually. I would say it's, I don't know if by numbers of accounts or by type, but my guess is that 70% of them are high net worth, 30% are anything from a hospital to a public company pension fund.
What's considered high net worth?
Well, a couple $1 million, anywhere to 20 to 30 maybe. High net worth to me anyway. Higher.
Do you do any absolute return for pensions and things like that, or is it? I mean, for the private clients, you clearly do an absolute return.
Well, and that question was asking me at lunch. Actually, Nick asked me about this defined benefit plan for this public company. We run the whole defined benefit and have for the last decade. And he said, well, doesn't the junk make them nervous? Which, great question. But I think the reality of it is, if you look at that portfolio from the CFO's perspective, he's not had to fund his pension in that decade, and we have not had a down year in that decade. And so he doesn't really care at this point if we're trading batons.
But again, they'll allow you because you run the whole thing.
Yes. Question.
For the absolute return focus, when the market's diving, what's kind of your strategy just to,
Well, I think absolute in that we're looking for, particularly on the equity side, an absolute valuation relative to what we think the private market value is. And when we can't find it, we're very comfortable owning a 90-day T-bill. Even though we've got, and I think it's here in a moment, I'll show it to you, I think we have an attractive small cap returns. When we can't find that valuation, we own a treasury. In fact, right now, I think in our small cap portfolios, keep in mind the Russell 2000's at about 40 times earnings. I think we probably are close to 50% or better in treasuries. But again, that presents a marketing conundrum. People look at your last 5 years' performance, want to give you money to manage, and then you buy them a 90-day T-bill, and they call you and say, well, what am I paying you to do this for? How am I going to get there? But I mentioned this at lunch, and I think it's true. If you theoretically were to buy a business at a 50% discount to its intrinsic value, and that business were to grow organically at 8%, and that discount was bridged over even as long as a 5-year period, you've got a 25% return on your capital. That's longer and slower than most people are used to. I think particularly in the private client business, it's kind of a game of how have you done in 18 months? I'm going to go out in the yard and pull up that oak tree I planted, and if the roots aren't growing, I'm going to go do something else. So that's, again, the challenge. I've got an investment philosophy that takes 3 to 5 years to come to fruition, but a lot of my customers are only going to give you 18 months to prove it.
Did you say you were 50% bonds right now?
Yeah. Well, no, it's equity cap, it's small cap.
I mean, that's it again.
There's huge tracking error in what we do relative to a benchmark for lots of reasons.
That's a very different product than the standard.
Yeah.
Where were you, say, a year ago?
Well, I can tell you, like in 98, 99, we were fully invested. But we were buying businesses back then at probably 6 times operating income with clean balance sheets and 4% dividend. We've searched the world over and can't find them, or at least the U.S. Here's the actual performance. I get a neat little laser on this thing. This is a balanced portfolio, which is really a kind of an all-cap equity and junk, a relative benchmark in that time frame. This is the last 5 years net of fees. This is all-cap equity versus S&P, small cap versus Russell, and then the high yield, which I'm going to spend a little more time, versus the Merrill High Yield Index. And then, again, since inception, it's remarkable to me how similar they end up with, not by design, over time in terms of a double-digit return. Again, I'm trying to deliver to our end user as little volatility as possible with a double-digit rate of return. But you have to be willing to argue with the market, which I guess I'm pretty good at. If I can get this thing to work, I'll be doing even better. On a risk-return basis, I think it's equally as attractive. I think you all are probably familiar with a risk-return chart. Again, to us, risk is not really volatility as it's academically defined. It's did we lose our customer money, which is, again, not our preference. You can see the NASDAQ's had a lot of excitement, but not much return. I'm going to go back a minute to the consultant's folly just because I just thought of it. I was looking at a consultant's work on done for a client of ours, and they had a unnamed large cap portfolio manager over the last 6 years, and the consultant had done a risk return chart, and I think the T-bill was over here, and the portfolio was over here, and it was maybe just incrementally positive. That was on one chart, but then they had one of those histograms, and it showed you where this firm was in the 94th percentile. And I thought, my, isn't that strange? They're high ranking, but they made absolutely no money. So that, again, is kind of the consultant folly. I think on the equity basis, what we're looking for, whether you're going to, I understand the 5-star is a great place to eat pizza from one of my UF grads. If you're going to try to buy the 5-star pizza joint, you know, you're going to look at the income statement, you're going to look at the balance sheet. I think probably because it's private, the income statement's probably figured out a way to suppress taxes. But you could always figure out what the cash flows were. And like I like to say, in the end, it all comes back to yield. You can almost take it to kind of a bond valuation. You know, what am I getting from an operational cash flow perspective in the numerator and the enterprise value in the denominator? On an equity basis, that's really where we start. That's usually the first place I run to in trying to figure out if something's even worth further consideration. For less experienced audiences, I refer this to like buying a house. Not that y'all are less experienced, but I do think the enterprise value is similar. When you go to buy your first house, you're not going to say, well, how much do you want for the equity in your home? You're going to say, how much do you want for the house? And you're going to assume the mortgage, you're going to originate your own. Well, it's the same thing looking at a business. So that's really the kind of, again, the starting point for us. I've got a really talented graphic artist that works with me. He's also doubles as a financial analyst. Talk a little more specifically about debt. And again, I think this helps maybe, I don't know if it does or not, calm some people's fears when it relates to junk bonds in particular. Because I think that the way I look at it is, I've always looked at it, whether it's an equity or debt, is how much can I lose? And I describe this as a corporate food chain. In distress, the people up here are going to eat before the people down here. The other consultant's folly I've seen in life, let me think about this one. They'll write an investment policy that says we can only have large cap stocks, but we can't have junk bonds. But they'll have, let's take 7 or 8 years ago, they'd have Amazon because it was a $10 billion market cap, but it was a CCC bond. Well, which one of those do you want to own if it can't sell enough books? I'd rather own the bond.
That's a great point. I mean, I've explained this to people before, they've never really got it, right? I mean,
well, it just trickles down.
Yeah.
Cash flow comes here, they get to eat. They get to eat. I would tend the banks probably first in line in most instances. They're probably secured by receivables or inventory or who knows what, but personal guarantees of somebody. Then you're here and then on down the way. But there are a lot of people, when they buy that little sliver of equity, are not thinking what's above them. So I think I could show you that there's a lot of places that you would really be better off in the debt than the equity. The challenge for a taxable customer is it's a tax disadvantaged way to earn a rate of return now that there's a disparity between capital gains and marginal top rates, 35 versus 15. Did you have a question?
Yeah, I was just wondering if there was a state limit on how much junk like a pension fund could take on. Is there like a law that says?
There probably is for a governmental entity. From a municipality, my guess is the state of Florida has mandated for the city of Gainesville pension fund, or the state of Florida is a different animal. Most likely. In fact, what you'll see in most municipalities is, one, an investment assumption they're not going to hit anytime soon of probably 9 or 10% that they're going to choke on. The ones that we run some money, they're not going to get there, even with our help. And they're usually restricted to, investment grade, large cap. Even a mandate to run a sub $2 billion equity portfolio gives them quivers, even though we actually do in South Florida run some small cap money for a municipality. Is everybody fairly clear on this?
One of the things that strikes me a lot. Everybody gets it, right? I mean, if the firm is worth $100 million and there's $70 million in front of you, the equity, if the enterprise value falls by 10%, the equity can blow it up much faster. But also, I mean, for people like you and I that are old enough to remember, when original issue junk first came out with Drexel and things like that, I mean, that debt financing had been around for a million years. It was on bank balance sheets, and nobody ever thought, work the other way around. I mean, banks have been, in fact, if you look at most of the commercial credits that are underwritten by a bank, if they went to S&P, they'd be junk. I mean, this lending in this kind of an environment has been going on.
They just securitized it and sold it to insurance companies.
Yeah, for 50 years. And banks and insurance companies have been holding junk bonds for a long time.
Right.
It's not like it's a very odd part of the capital structure.
Right.
Well, again, and it did come up in discussion at lunch, and I'll talk about some successes and probably even more failures on my part, but you keep in mind that there's opportunity in distress situations where this gets, as Dr. Brown said, is wiped out, and if you're up here, you're now an equity holder. Well, if you'd had the cojones to buy WorldCom at 11 cents on the dollar, it converted to equity at 36. Well, it remains to be seen what happens at Adelphia, which we talked about at lunch too. I'm trying to think what else. Enron was a complete kaputz. And I think actually Winn-Dixie is in Jacksonville is going to be the same due to all their leasehold commitments. Are there any questions? Again, I think our strategy is a little bit more of a hybrid. If you're really today to look at the Fidelity, I can't think of the specific Fidelity mutual fund that's probably several $1 billion, or if you're to look at a Putnam HighYield fund, the problem those funds have, a problem of prosperity, I guess, is they're so large they really have to own every issue. And they tend to be, because they're sold through a financial planner or however they're sold by a consultant, they tend to be junkier than what we own and a wider spread and a longer duration. And they're so big they have to kind of buy every issue out there to keep their money put to work. Being a good ship lollipop with $500 to $600 million under management in Intrepid Capital, we can kind of navigate those waters a little bit easier than.
You have that amount of money in the management, you also have a mandate which allows you to be heavily invested out of the market or in cash.
Right. Right. If we can answer their questions when we're out. The other thing I've tried to do, sometimes more successfully than not, is to try to take the interest rate risk out of the equation. And it's also kind of a personal bias that it's very hard looking at, in my opinion, looking at a corporate financial, almost any business, maybe short of GE or Exxon, and forecast out 3 to 5 years, 5 years in particular, trying to really bring it back in and kind of take the interest rate out of it and just make it a credit-specific issue. So that's usually what we're looking for. I'm going to contradict myself here in a couple of slides with a few examples that are actually outside of that. But again, as you probably remember in Dr. Brown's class or others, you lower your coupon and it's going to stretch out your duration typically. And so that's kind of the environment we're in right now with kind of spreads that are relatively narrow historically. Again, unlike a lot of our peers, I think if you're to to lift the hood on a typical high yield mutual fund or even an equity portfolio. Many times you're looking at a portfolio that's probably 120 to 150 issues with a higher turnover than we have. We tend to be much more concentrated. That has both beauty and peril. The beauty is I think we can understand what we own better. The peril is if we're wrong, it's going to show up pretty quick. I think at the end of the day, that's really the question you've got to ask yourself is how am I going to get my money back? Some of y'all may end up in bank credit departments. I don't know if anybody's headed that way or not. That might be good background for this at some point. I really, in a very general sense, tried to classify the three ways that we think of and how we're going to get paid. Probably the less, ideally, we can get one that has this and this as a backstop. The refinancing window is a very fickle thing. The life cycle of high yield tends to be that when everybody's happy, they issue a lot of it, and about 3 to 5 years later, it blows up and spreads widen out, and issuance dries up. And if you're dependent on refinancing that debt and don't have the cash flow to have any principal reduction, you're in trouble. So we tried the best we can to avoid someone that's strictly dependent on refinancing.
That does come around a little bit contrary to your, well, maybe not, but your focus on relatively short duration stuff means you run into a lot of opportunity in your portfolio.
Yeah.
So you've got that.
Yeah. Sure. Well, and hopefully they're seasoned and past that kind of point where they're not going to make it. I've already mentioned the refinancing. Again, the shortened duration, anytime you got a zero coupon interest, zero coupon, you're stretching it out. And again, a lot of people that we're managing money for like to have the cash. So we tend to avoid a zero, both for the duration reasons and there's no cash flow. I've never liked, for lack of better terms, roll-ups. A lot of them are done with debt. They're a great source of short sale opportunities on the equity side eventually. And again, the cyclicality is something you just have to juggle. I think a lot of them have some of that in their business.
One thing you did intent on making acquisitions. Do you know the management pretty well? Is that how you do that, or you?
We're probably going back to the food chain. I think we're probably more interested on the equity and understanding the management, which coincidentally we had a situation that they didn't tell us the truth yesterday, but on an equity security. But on the debt side, I think less so. If we feel like we've got some protection, which I think these couple of issues that I'll show you are really pretty, down the middle of the fairway. I think if you go back, as Dr. Brown mentioned, the advent of high yield really came forth with Michael Milliken in probably mid to late 80s. I think Drexel Burnham went bankrupt in 88 or 89, as I recall. And the spreads have fluctuated between then. But, let me get to my next slide. You can see the last trough in pricing we had was somewhere in the fall of '02. Just to give you an idea, we were buying debt back then that was probably 1,200 over the Treasury curve, 1,200 basis points. That peaked, I'm going to say, about this time last year. Somewhere in February, March of last year, spreads got down to probably 330, 350. And then they widened out in the spring, and they've kind of modulated since then. But you can see going back into the early 90s that, the average spread was in the, 500 basis points. So we think things are a little bit rich right now, both on a small cap perspective and a high yield. Hence, we have more treasury bills sitting around than we normally would. I think we look like y'all have probably learned in your fixed income classes, kind of the traditional metrics. Some of these we spend more time with than others. I think the one I particularly like is here at the bottom. Particularly, even though we said we avoid them, we probably end up there sometimes with cyclicality is, what does it really cost to keep that business running? Just because they can cover their interest expense, that assumes they don't plow back any money in their plant and equipment. We had a company that you're probably familiar with. We own some debt. Y'all familiar with the company Muzak? Elevator music? You walk into a store and it plays music on the PA. Y'all are so used to your XM satellite radio, you've forgotten such a thing exists. Well, there was a business that we owned, the HighYield, for a while, and we finally came to the realization that they couldn't grow their way out of their problem. They didn't have enough money. They could cover their interest, but they didn't have enough to plow back in, and because there was a time lapse between when they signed up a new customer and when they started receiving cash. They didn't have enough money to really get home. I don't think that has played itself out fully at this point. I think they're still a going concern, but we left thinking that they might not be.
What number would you like? Above 3, 4?
Well, I think, Nick, you'll see the ones I'm showing you today are well above that, or a couple anyway. There's time periods when the spreads are wide, you might hold your nose and take a little over 1. I would encourage those of you who have the opportunity, if you get a chance to work on a high yield desk, you should take it. I don't know what Dr. Brown's experience was when he was in St. Louis, but I can tell you mine that I want to have the opportunity to collect a payment on anything that goes across my desk where the only person that can tell me what it's worth is the guy that sold it to me. I'll never forget back in the late 80s, I had an elderly gentleman came in to see me, and he said, I've got a couple $1 million in munis, and he said, they don't charge me anything to manage that money. I said, oh, really? How does that work? Well, whether you realize it or not, bonds, be they junk or munis, are just like shoes or loaves of bread. You bring them into inventory, you mark them up, and you sell them. Well, I think you need to understand that when you're trying to negotiate to buy a bond. Granted, the advent of the trace system, which you may have access to from a Bloomberg around here somewhere, you can actually kind of see where the last trades were. That's only been out, believe it or not, in the last year. It started out with investment grades, and now they've actually got junk on there too. Before that, you had to kind of triangulate to figure out, is the guy at Goldman telling me the truth and the guy at Bear's lying to me, or the guy at Merrill's right and the other two are lying? Not to disparage all of them at one time, but I guess I just did. With that said, I think it's a business where you're highly dependent on them for your success in trying to get what you need when you want it at a good price, but at the same token, get out if you really need to get out. It's not like going online and selling a few shares on Ameritrade. So it's where you have you're like the remora and the shark, I guess. As far as your relationship. I'll talk about a couple of successes, and maybe I'll talk about a couple of my failures. American Airlines, I think this maybe gives you a feel for what we try to do in high yield. I remember there was, and it seems like the airline industry has been perennially troubled. I've always liked the quote from Warren Buffett, if investors had been smart, they'd have shot down Wilbur and Orville Wright. Save people billions of dollars worth of losses. I didn't hear that quote until after I bought a lease on a brand new 767 Boeing, and it was an American Airlines plane, and I bought it thinking I was getting a great deal at 52, and lo and behold, I woke up the next morning and it was promptly quoted at 17 cents on the dollar, which really explains why I've lost hair, which you couldn't see from the front. Fortunately, things did improve. And my intuition was correct, and they came through it. and I was never more happy than the day I sold that bond or lease for about 85 cents on the dollar. The Hilton Hotel converts were available in mass right after 9/11. For those of you are probably aware, the markets closed for 7 days post 9/11. And when they opened back up, I remember I was in my driveway, and my wife said, "What do you think is going to happen?" I said, "Oh, down about 7%. I think I was pretty close. But in the meantime, I think after 9/11, a lot of people figured that no one was ever going to stay in a hotel room again. Somehow I differed with them, and I was able to buy the Hilton Converts, which was a fairly senior in their capital structure. I want to say 80 cents on the dollar with a 5% coupon. The occupancy rates, RevPAR improved, and we're able to sell it at par and not too long thereafter. And the last one I just want to talk about a little bit, and goes back to the bond brokers. You got to keep in mind when you're dealing with a brokerage desk, you're typically assigned a salesperson and then a trader, but they work as a team inside the big brokerage firm, usually where we're trying to find the inventory, and their year-end bonus is driven off the profitability of that desk. Well, you need to use that the psychology of that P&L to your benefit, which is, as it gets later in the year, they start tabulating what they're going to get at Christmas. And in the case of long-term capital, that happened in the end of the third quarter of '98. The Russian ruble had been devalued, I believe, in August. Long-term capital was bailed out by the Fed and a consortium of big investment firms in late September. But every high-yield bond desk and the traders on them kind of went like this, thinking, oh my gosh, I don't want to trade because I know what I'm going to make this year, and I don't want to bid. And really, there's a lot of things that if you throw out a bid, they just sell them to you because they didn't want to hold them in their inventory, not knowing what's going to happen. So I think there are a lot of things that, just like Dr. Brown and I talked about before we got started tonight, a lot of it you just have to learn by doing. Some of it is intuitive and some of it is academic. In the case of some of these, it was a little more intuition than could be academically quantified. Let me talk about some failures. Most recent one would be Calpine. We talked a little bit about this at lunch today. We did own the April tranche of '06. I don't know if you followed that story or not. Calpine was kind of a success story in the late '90s and a failure in the 2000s. Equity's gone all over the board, back down. I don't know where it is today, probably sub-dollar or sub-2 anyway. We owned the April issue thinking that they had liquidity to pay us off, and as we describe it, their maturity wall, the climb, was in '08, '09, and we could see they had enough cash to pay us back, but then they lost a court case where the disposition of an asset was not going to be available to pay us off as a bondholder. I started smelling smoke. I think we bought those bonds in the mid-'80s. We were real fortunate to sell all of them in 63, 65 cents on the dollar 2 or 3 days before the CEO and CFO resigned, and they declared, and the bonds promptly traded in the mid-30s. Asbestos related, I have yet to figure out why we stopped using asbestos in 1972, but the amount of claimants continues to skyrocket. Congress even recently is trying to figure out how to come to some type of settlement of that whole issue. A lot of CEOs have expressed kind of disgust with the whole legal process. I'll express disgust with that legal process. A lot of people that have not shown any sign of mesothelioma have been able to go into court and walk out with $30,000. I think they've yet to really show, it seems like to me the common denominator is they all smoked. But, they rubbed up against some pipe somewhere, so USG owes them money. It's interesting, back in the late 90s, though, how lots of industrial America was painted with that asbestos brush. The one that comes to mind, probably more clear than others, well, two actually. One was Crown Cork and Seal, which I think had bought a subsidiary in 1962 for some infinitesimal amount of money, and they had been able to trace it up the line and give them some billion claim. But at that point, we owned Owens, Illinois, Armstrong World, Crown Cork, and then USG, which, again, as we talked about at lunch, has actually worked its way through the process. Bill Foote, the CEO of USG, said at the time, "Look, I'm gonna cap all this nonsense that's going on in the courtroom. I'm going to declare just to quantify what I exactly owe." And he's actually been able to protect his shareholders' equity by doing that. The other situation, litigation-wise, it was similar to that, related to litigation, some of you may recall or have read about, was Texaco. Texaco actually sought bankruptcy back in the mid-'80s. Does that sound right? Mid-'80s over a kind of a runaway jury settlement. And then lastly, still kind of working its way through, Adelphia. We own the converts. Just to double our pain or pleasure, the converts ran down as they declared. We flipped from there into the senior paper. As I said, thinking we get post-petition interest, they traded from the mid-40s up north of par, and then some of the subsidiaries have started to squabble that some of the intercompany transfers were fraudulent, and the bonds traded back from 104 to the high 50s, and yesterday they're in the high 60s, which again explains some of my hair loss.
Well, let's talk a little bit, because there's kind of why this whole process of this kind of space is really interesting. So you've got more than just trying to understand the fundamental business. You've got which claim to own. Sometimes you own the senior debt, sometimes you own the convert, sometimes you own whatever. And also, in the case of, this was, I forget which one had Calpine, I guess. Yeah, Calpine was a story where you have a view on Calpine, but one of the bonds is the maturity spectrum. So there's not a grid. You've got maturity and you've got.
That's a great point. I never thought of it until you brought that up. Yeah, we're thinking about where we are in the repayment cycle. Not only how far are we up in the capital structure, but how far up are we in that particular tranche? Right. Where are we in getting? How close are we to getting repaid relative to their other debt? Yeah, it's interesting. It's really in some ways more equity-like than. And again, I tend to think of this asset class kind of as an equity surrogate. And really, as crazy as it sounds, to me, an equity return is around 10 or 11%, which is about what we've been able to do. Oh, certainly.
Do you avoid some of the companies? I know some of the companies, like power companies, have like multiple subsidiaries, and they each of them issue their own debt, or just have kind of complicated organizational structures. Do you?
Yeah, that's a great point. And Dr. Brown, that's what I was trying to. I just remember when he brought it up. You take Adelphia. If you look at a corporate tree, I guess that's the term I'm looking for. Maybe there's another one, but if you were to draw a schematic, is I guess the word I'm looking for. Draw a schematic of their it's quite elaborate. And today there are various subs, believe it or not, in Adelphia that may be trading close to par, where certainly the converts are way down. I can't think of any power companies specifically, but you really have to figure out and read the covenants and figure out where you are relative to your claim. And it always comes in a really small print. Yes?
On that last slide, you had American Airlines as a success story. I didn't quite understand the deal because it sounded like a loss.
No, I bought it at around 50, 52. It traded to 17, and I was able to sell it in the mid-'80s. It swung me around. And again, that's so completely different than the typical investment grade credit. You go out today and buy a 5-year piece of GE paper, and I would be willing to bet you could go around the world and play golf, and it'd be right where you left it, or it's accreted toward par. I mean, I've accused, and Dr. Brown can cover his ears. The guys with the best handicaps in the financial services world were investment grade bond managers. But what they did was they worked on their handicap, and then when they got a downgrade, they came in off before cell phones, ran in and called and sold them, and then sold them to guys like me. Is that close?
Pretty close.
This is a particular issue that we own. Again, it's a little bit of a violation of what I said earlier. You can see it's a little bit longer final maturity than our preference. They are kind of a neat company in that unlike the meter man that's going to get attacked by my 2 Labradors coming in my yard to read my meter, they now have the technology to drive by and scan your electric meter. They can probably eavesdrop on you too, but they're not using that technology. We can talk about that later. Second violation, they used the debt to fund an acquisition. I think the good news is that they have, as you can see, they've obviously got a lot of free cash flow. They brought that debt outstanding down $100 million in the last 12 months. And again, Nick, I think you can see the kind of credit metrics, 5 times over CapEx. Those are real strong coverage ratios. Those are probably, I think one point I'd make out too about S&P and Moody's. A lot of times with a small issue like this, I think this one is 100, 120 million. They'll give you a lower credit rating just because it's small and less liquid. So again, that's a little arbitrage that we can work as a smaller firm, is that we can own something that really probably has metrics that give it a triple B, but it gets a little hair on it because it's just a small outstanding amount of debt.
What is it? Double B?
Yeah, like double B plus. We've tended to when spreads are wide, just kind of sift down toward a single B minus, and then as they, we try to work we're on our way working back toward triple B minus with a shorter duration. I don't think it's top-down driven, but that seems the way it kind of evolves. On this one, again, a yield to worst, 7%. You get 240 basis points over the respective treasury. I'm sure y'all are familiar with the Daytona 500. This is not the Daytona 500 company. That's International Speedway, run by the France family in Daytona, which coincidentally we actually own some of International Speedway stock. This is ticker symbol TRK out of Charlotte. But the economics of running a NASCAR race are really pretty good. You put up some concrete bleachers, you put an aluminum seat on it, and you pre-sell your tickets from here to eternity. And best I've checked, I think I counted at least 5 or 6 or 10 number 8 stickers on every pickup truck I passed on down on 301 on my way here. So it's a popular sport. Again, a little bit longer than normal. You can see we're constrained again by a little shorter coupon that's stretching us out. A lot of this profitability and predictability in their business model is off of their television contract.
Now, in a situation where you have, a longer maturity bond in this name, but is there a shorter? There's probably not a shorter term bond available, right? So that's, if you're going to, that's the only issue.
Yeah, I think in both cases here we own the only debt they have. Again, the metrics are pretty compelling. What's interesting though, just like I used the example prior, this one's a little bit bigger, both in market cap and size of debt, and you can see the spread's a little tighter and your yield to worst a little lower, although the coverage ratios are, I think, pretty comparable. And again, I think this one might have a little bit more outstanding than the Itron. I know most of y'all weren't around in 1980, but I've got a little clip for you.
One of the truly great moments in Georgia football history featured these two men, quarterback Buck Bellew and receiver Lindsey Scott. November the 8th, 1980 in Jacksonville's Gator Bowl, Florida leading Georgia 21-20. With a minute and a half left in the game, Georgia's ball third down on the Bulldogs' 7-yard line. Blue scrambles out of the pocket and throws over the middle to Lindsey Scott. Lindsey takes the ball, heads for the sidelines, and turns on the afterburners. In the words of Larry Munson, run, Lindsey, run, and the rest is history. Georgia wins 26-21. The Bulldogs go on to an undefeated season and claim the national championship. And that's another great moment in Georgia football history.
I was actually at that game. That was 1980. It was a long time ago. I'm sorry?
Is that the Herschel Walker?
Yeah. The first play of that game, Herschel Walker went around in for about 80 yards, untouched. The guy was a phenomenal athlete. I mean, and even today, he's a phenomenal athlete.
On the question, how much, and when you, how much color do you get from that's valuable from the institutional salespeople that cover you? Talk to them much, or more about pricing, or about fundamentals?
Usually we've done the work, and we're trying to get pricing. Not to disparage them, because some of them are, and this is a general statement, they're trying to sell something. And generally we're trying to buy it or sell it to them. There's occasionally where they'll have a sell-side analyst that may cover this credit that we'll want to talk to verify some work we've done. And we'll ask that salesperson, can you connect me with Joe Smith that covers this, Itron issue. I'd like to talk to him. But I'd say that's more rare than not. I think that's the real challenge again for Intrepid Capital is a lot of the consultant-driven money management selection really are driven off of commission dollars, and we run a firm that turns over a portfolio maybe 30% a year, and so we're not a consultant/broker friendly asset class. They can hire, there's a manager that I'm familiar with locally that turns over a portfolio 600% a year, and that broker is pretty happy to hire them as a manager versus us who doesn't trade very much. But I would say the credit analysis done at some of the big firms, Lehman, Bear, Goldman, if you can get it, and it's worth looking at. It depends.
Get your basic ideas. Do you run a screen to trickle down? I mean, how do you manage all those names to get it to 4? Very day-to-day.
Yeah, I think it's, well, let's put it this way. I think it's different on the equity than the debt. Let's talk about the equity because I can give you that more quantitatively than the debt's a little more subjective. I think on the equity, I want to go back to that enterprise value and operating cash flow. With Bloomberg's and, cheap CPUs, you can do all types of screening. As I said earlier in the day at lunch, one thing I've picked up from, classes like this is more of an interest in quantitative-driven strategies, technical overlays. I think the challenge for me in being a CEO of a firm that's kind of a classical security analysis driven is culturally how do I convince them that quantitative techniques like Robert's probably familiar with that might add value to our customer, whereas they kind of look at it like putting your hand on a squeegee board. But what we do in the equity side is we're really looking for make it really simplistic, yield. What is the operational cash flow relative to the enterprise value? That's our first kind of cut at it. And then from there, trying to, we'll order the Qs and the Ks and the annual, listen to conference calls, and try to figure out, one is a business we want to keep in kind of in our library inventory of information. Do we want to value it and say, well, I really love this business, but I'd like to buy it 30% cheaper than where it is today? On the high yield, the challenge with screening quantitatively, to me, high yield, is that you can do all the wonderful work you want screening, and then you can call up your favorite bond broker, and they say, well, that's great, Mark, but. And the but is it's locked up at Mass Mutual, and they don't want to sell it to you. So I think the way I look at high yield vis-a-vis equity, which usually if we find it and we've done the work and we think we've got a discount to the intrinsic value on the equity side, we can go out with a limit, usually in small cap land, and make a purchase. High yield, I think we have to come at the market as with a mental template of what we're looking for, like the specifics I gave you, and then kind of wait and see what swims by, for lack of better terms, and just wait.
There's several hundred probably names in the junk space, but again, these things don't trade regularly, and it's not that you can just say you liked it, and that's even true in investment grade corporates too. It's small. You can't just say I like it and go ask them to buy it.
Yeah, so you have it's combination of having a mental template, being able to fairly quickly do the work on it to see how you're going to get repaid, and then can you, after you've done that, quickly go back, having seen it swim by, chase it down and get it. Well, if you're familiar with the Bloomberg machine, at the bottom they have a message that just kind of scrolls all day long. And once you're on a distribution list from a broker, you just have, every minute you've got something swimming by. So, that's what makes it a little more dynamic in some ways than the equity market, is that, it's they're hard to find. Again, I think where we've been able to add value over time is when the markets, for whatever reason, have had kind of illiquidity events. We've been able to show up with liquidity and make opportunistic purchases that worked out. But a lot of times you can do all the quantitative screening and not, you can find 10 issues and start making phone calls, and then you've wasted your time, or you can't fill any of the orders.
I guess that's one of the things that's always been a little bit dominating for me about the debt markets is there's no New York Stock Exchange that, that everything trades on. You can't get on Yahoo and pull up a quote for whatever your issue is. Are you working primarily through different bond dealers when you?
Absolutely, yeah, absolutely. We probably, I think we probably settled trades to 40 different places, broker dealers. We probably buy debt from most of the big houses on the street, predominantly Bear, Goldman, Credit Suisse, First Boston, RBC, Royal Bank of Canada, Dane Roche, or whatever it's called. There are occasional you'll find a boutique high yield broker dealer, but you got to be careful because a lot of them have figured out big spread, sometimes unknowledgeable buyer equal I'm going to mark these things up maximally every time, and you're playing a little bit with dynamite sometimes in dealing with them if you're not careful. Yeah, it's typically coming out of one of those shops. The problem with going to a more retail-oriented shop, say Charles Schwab, for example, Charles Schwab's customer base is predominantly retail, so they don't want to tie up capital in a type of issue that their customer's not going to come and ask for. So they, in fact, I want to say in the last 10 years, I believe Merrill Lynch has quit making a market in a lot of municipal debt for that same reason.
Yeah, they do, and actually when I left the industry, I love Calpine Energy so bad. I have a little retail account here at Merrill Lynch. It was the best thing that ever happened to me. They didn't have the bonds. I lost interest a week later. I love that name as well. Because they didn't have it and I was busy, I just didn't try to go hunt it down, and I got to dodge that bullet.
Oh, happy day.
It's better to sometimes than bad, be lucky and smart, right?
Yeah. Yes.
Do you have to search out for your bonds, or do people give you a call and say, I've got something for you?
Well, if you'll take the call, they'll call you. Meaning, I don't have any lack of candidates wanting to sell me something, if that's what you mean. No, I mean, if there are plenty of people that will call you 3 times a day to sell you a high yield bond, whether it's something you want or not. But I think over time you get where you have a reasonably good working relationship. with them. They know what you're looking for. They know what you own. They know that you know what you're doing. And it gets to be a little symbiotic at that point.
It's a little bit two-part question, so if the answer is no to the first part, just take the second one.
Okay, so I know the answer now.
And it seems to me, we got the north line. We have to stay here till 3:30.
Oh, darn.
The
It's the longest I've ever talked. My
My
wife just thinks I read.
The terms are hard. We didn't give you all those terms, but it seems to me as an outsider that below investment grade goes through periods of time, and I've been in and out of it a few times. I've been right. That it goes through periods, maybe your graph showed that, where it looks almost stupidly cheap and almost stupidly rich at points of time, more than any other sector to me. And if it does run through periods of where it is of value and where it's overpriced, where does that come from? Does that come from the sort of the street not wanting to hold it, or is it more the retail investor base runs hot and cold?
I don't think junk is really subject to retail whim, by and large. I don't.
But do you agree that a premise that at times it looks...
Oh, yeah. Well, I think that despite the best attempts to academically quantify, and make it efficient, it's not.
Right, okay.
And so it's not an efficient market. And, like I like to say...
Furthermore, just make sure that people get... It's not so much that name by name it's not efficient, just the whole sector at times.
Yeah. And really, I can't quote it accurately, but something to the effect, the whole entire size of the junk market is but a small fraction of what trades on the New York Stock Exchange. So it's a relatively small in kind of total market cap relative to many other things. But I like to describe a lot of times investment opportunities are best available when most people are under their sheets with a flashlight on going, oh, what are we going to do now? So even though retrospectively you can say spreads were 1,300, there were people under the sheets with their flashlight on shaking going, how am I going to get repaid? I don't want to put any money. Why would anybody ever? I'll never put money there again. Just let me out. The same thing's true of small cap businesses at times.
Yeah, maybe you
I mean, I'll say it on the record. I think that the market equity cap has shifted so far concentrated to the smaller names, the probably relative opportunities are bigger now.
Well, maybe something that I probably gained a much greater appreciation for today. So let's suppose we're in a period of where junk bonds are cheap. We all kind of agree to that. Well, there's two forces that I didn't really appreciate much today that I do now. One is, the consultants aren't going to move people in. And two, if you're more of a hedge fund or whatever, the space that has a latitude to do that, given the illiquidity in the market, it's hard to just, say, here's $200 million, let's go put it to work and pick up the phone. I mean, you're going to get, the pricing's not going to be very good. It's going to be a brutal process to put that money in play.
That brings up another great point. I mean, and I've seen this where we've had customers try to sell off fractional interest. It's very hard for the retail customer. It'd be virtually impossible to buy $15,000 worth of the Itron or Speedway bond. You might be able to buy it, but we might have bought it for 80 cents on the dollar, and you call up 5 minutes after us and pay 95 cents on the dollar. So the only way to kind of get exposure on a retail level, again, we're trying to buy in $1 to $4 million blocks, and then allocate them out to a customer proportionally. The only way you're going to get money into that asset class is likely through a no-load or maybe I don't know if there are ETFs or not. Are there junk ETFs?
Not aware of them.
I'm not aware if there are.
But even institutions that might want to come in and add a big space there, that's going to be hard. It's very difficult for retail, but even institutions would have a hard time putting that money to play quickly.
Yeah, I think the institutions just have a hard time by the very name junk. they don't usually make it past that. Yes.
Have any of the brokers ever tried to push other products in that credit space, like credit default swaps or anything like that?
They'll sell you whatever you have any interest in buying. And I think the good ones try to figure out quickly where you are, meaning what's your end customer look like, what is your position size, what biases, pro and con, do you have, and then they kind of keep copious notes in their CRM software, and then if they see something that they think meets your parameters, they'll try to show it to you. The less knowledgeable ones just throw stuff at you. Have you looked at this preferred? Well, I don't buy preferreds. I hate perpetual preferreds. Do you want to convert? No, I don't want to convert. So I think the good ones, good salespeople in general, take time to understand what the buyer might want before they make a recommendation. It's that inquiry that sets them apart, I think. I would say that about any salesperson, really. Yes?
Did you pick up any GM after the downgrade?
Actually, GMAC. We'll see if it works out. Yes?
Yeah, that brings, when you buy bonds, is there ever any strategy that counts on merger or acquisition like on GMAC?
Well, that's a great point, and I meant to mention that earlier. We actually looked earlier, maybe in the fall, we were looking at some Toys R Us. And there's such a huge amount of money now in private equity pools, and this kind of ties back out actually to GM. There's so much money out there sloshing around that, there's some businesses that have perennially been LBO'd. Mattress businesses, publishing businesses, and you got to think about that when you buy the credit, because if somebody comes and takes it over and stacks on debt and puts debt on there and takes a dividend out for the private equity guys, you just got shoved down farther down the corporate food chain. GM is an example where in the paper this morning they're talking about Cerberus. I think that's how you say it. Cerberus. How do you say it?
Cerberus.
Say it one more time.
Cerberus.
There, good, thank you. Almost got it. They, along with, I think, a private equity part of Citigroup, are trying to, buy GMAC. Well, the question is, do they really get a credit upgrade from S&P from a, financial buyer versus a strategic buyer? I really think that's going to be interesting to see how that works out. I think, to me, I don't know. The embedded costs in the way they make a GM car is hard to stay competitive. How they deal with that, I don't know. It's going to be painful for all parties, I have a feeling, both the labor unions and the equity holders. I don't see, I think there was an analyst, and I know you read the same article, there's an analyst talking this morning from B of A talking about selling GM was like trying to sell your bathroom in your house. And I thought that was a really great analogy. He said, well, that's okay. You get kind of limited use of it, and you got to make sure the house stays up, the roof stays on the house. I think that's probably what would happen if you bought, GMAC. But the other side of it is you're going to sell off your best cash-generating, profitable piece of the business, and you're left with the worst part. And so, have you just delayed an imminent demise? I don't know. It'll be interesting. I don't know those answers.
You avoid LBO type any company that's either about to be or has been recently?
Well, I think you have to be cognizant of that as a possibility. We took a pass, for example, at Toys R Us, and fortunately, it was kind of in the midst of being bought out, LBO'd. We actually own some zero coupon Houghton Mifflin, which again violates my zero coupon thesis. So there's exceptions to all my rules. Some Houghton Mifflins today, but we were probably close to selling those, which was a product of an LBO. The one that always comes to mind is the all-time favorite is like Sealy Mattress, I think. It seems like Sealy Mattress has been LBO'd, 5 times in the last 20 years. I never realized that was such a great business. I guess everybody's got to sleep somewhere. Yes.
Are there any books or associations that are written for the junk market, or that you would suggest for us?
Well, I would suggest in general for those of you who are so inclined that the CFA program is worthwhile. I think having completed a year here, you're a natural shoe-in for passing level 1. Level 2 is a little different game, and level 3 is probably maybe not quite as bad as level 2, but I don't know, having survived 4 years of undergrad and 1 year grad, you want to take on another 3 years of self-study. And I'm not sure, frankly, other than the Handbook of Fixed Income by Frank Fabozzi, you can probably read a couple of chapters of that and pass on the CFA maybe, I don't know. But I can't think of an association specifically geared that way. There may be in New York or Boston, not around here that I'm familiar with.
Regular newsletter like there is you need to have the bond buyer.
Yeah, no, I can't think of one. Any other questions? Yes.
Again, how you pay money up as well as liquidity crunch.
Well, I think that the way we did it was just putting out some lowball bids, and the market, the active market probably 2 weeks prior on, let's just say, something we were interested in, I'll just use a Hilton just because we talked about it, might have traded at 80, 82 cents on the dollar, but all of a sudden you brought in this exogenous event, and everybody kind of panicked and said, let's not trade, get everything off your desk, let's reduce our exposure, let's just kind of hunker down and see what happens. Well, you can call up and throw out a ridiculous number, and they may hit it. So it's really kind of a salvage type operation. That's why I said I'm a repo man. They were throwing them away, and I said, well, let's see what happens. So some of that is quantitative, some of it is academic, some of it is having a mental template, and when the opportunity presents itself, being willing to kind of jump out of the airplane and hope your chute works. And hope if that one doesn't, the backup one works. Yes?
Say you only look at a credit as just an opportunity to buy. How much does an exit strategy come into play when you buy something? Afraid that you won't be able to get rid of it?
Oh, I'm always afraid. Yeah, I think that equity or debt, I'm always afraid. What's interesting about our process is that the equity is almost the inverse of the debt. If you look at our equities, a lot of times they have cash-rich, unladen with debt balance sheets, whereas the debt are levered up, single B credits. So I'm always worried about it. I tend to think about it, Dr. Brown and I were talking earlier about Bill Gross at PIMCO, well-known bond fund manager, I think. Y'all would recognize the name. A lot of what he learned in life early on was playing blackjack at Las Vegas. A lot of his basic premises of PM are kind of driven by game theory. Well, to me, some of what I've learned was actually trying to design commodity currency futures trading systems and just portfolio management math. One thing you'll learn as a budding commodity trader, if you ever want to go that route, is how much risk control matters to staying alive. And let's just take a bond. Let's say you bought a bond at 80, and let's say you put a 4% weight on, and you have a negative occurrence, something you hadn't anticipated, and let's say the bond's now at 62. Well, I've lost what, 80 basis points? Is that right? Did I do that right?
Went from $80 to $62?
Yeah. Well, I was thinking a 4% weight.
Yes.
Isn't that right?
I thought you were talking to me, but much more than 80.
No. So I've risked about 80 basis points. I view that as survivable. Again, it may not trade it. It may not trade at 62. It may go straight from. It may do a WorldCom straight from 80 to 11. I don't know if Enron had debt where it went, but I think it went to SIPO. So that doesn't always work, but I think you've got to keep that in the back of your mind. And again, that's helpful to have active relationships with brokers that will work for you when you call them. But again, if you had, going back to asbestos, I think if we were probably at that one point a little too concentrated, whether we realized it or not at the time, I think going in, we thought these are, Armstrong World, what does it have in common with Crown Cork and Seal, a bottling business? What does it have work in common with USG in Chicago that makes sheetrock? Well, what they have in common is somewhere in their genetic schematic, they own something related to asbestos. And all of a sudden, my portfolio management math didn't really work so well. All of a sudden, they traded in a very linked fashion, but you didn't anticipate that, or I didn't at the time.
Thank you.
Thank you. Thank you for having me. Oh, by the way.